Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert Joe Fairless. Now, guys, for those that don't know, Joe is the co-founder of Ashcroft Capital, which currently has over $2 billion of assets under management. In addition to his work with Ashcroft, Joe created the podcast Best Real Estate Investing Advice Ever Show, which is the longest running daily real estate podcast in the world. So guys, with that, it's an honor to welcome the man, the myth, and the legend, Joe Fairless, back. I think it's been a couple years since we had him, so welcome him back. So Joe, how you doing, my friend?
I'm doing great and good to be back, my friend. I'm
Yeah,
excited about this.
it's funny, Joe. I thinking back on when we first talked. I don't remember the year, but it's funny.
Oh,
I think back of when I started doing this podcast. It kind of ages me a little bit. January of this coming year, January of 2023, will be 9 years from when I launched it. And it's funny. I remember interviewing you on. I don't know. It was one of the first. Maybe in the first 20 shows I did. I interviewed you. We were connected by a mutual friend of ours. I think that you worked with in the advertising world way back
yep.
when, and your story revolved around, I think, the first larger multifamily deal that you had done, and you did some creative lease purchase strategies,
Yeah,
I think,
yeah.
as one of the
Master
others.
lease with
So,
option to purchase.
and I
Yeah, good
remember
memory.
us having a conversation about podcasting. You were thinking about starting a podcast, and it's funny because back then, either you knew what a podcast was or you didn't, right? Like there was
hmm
two very distinct camps. Now, I think even probably most of our parents and grandparents know what a podcast is. Maybe not grandparents, but definitely our parents do, right? But that was not the case back then. And so it's been a long run. You've been running a daily show. I don't know how many episodes have you guys knocked out over. It's been 8 years for you, right? You started your shortly after I started mine.
Oh my. Yeah, I didn't stop to think how many years. Yeah, we're at episode around 3,000. I believe. So I don't
Yeah.
think we've gotten to 3,000 yet. And we do it 365 days out of the year. So let's do some math. If we were at episode 3,000, we'd be at 8.2
There
years
you go.
into it.
Man, that's awesome. Congrats, by the
Yeah,
way. Congrats.
thank you.
That is a huge accomplishment. And guys, it's funny. I do one show a week. There's been times over the years where sometimes I've done 2 or even 3 shows in a given week, and I used to run another podcast as well. And it's definitely time consuming. So just what an achievement in and of itself to actually have a weekly or a daily show running that long. I'm
It,
assuming other people probably tried to mimic when you did that. I'm guessing there's probably some other people, whether it be in the real estate industry or other industries, that tried to mimic that practice that probably got burnt out shortly thereafter. Maybe they made a year.
understandably.
Yeah,
and
absolutely.
and so first off, shame on me. I'll be the first one to call myself out. I just did a Google search. We are at episode, as of this recording, 3,016. So
Okay,
we have passed the 3,000
that's
episode
awesome.
mark 16 days ago. And yes, I got this idea from actually Trevor McGregor, who uh, some of you might be familiar with. He was helping consult me right out of the gate when I first got started in real estate, apartment communities. And he's a Tony Robbins coach at the time, and he was focusing on mindset with me. And he said, you should look at podcasts. And so I've was interested in it, but I wasn't listening to any podcasts. And I really don't listen to podcasts now either. Never have. But I said, okay, well, let me look at it. So I started interviewing people, and I launched a podcast, but it was not daily at the beginning. It was just a hobby. And I realized after doing about 15 episodes spread out over about a month and a half, I didn't know I didn't know if it was good use of my time or not.
Mm-hmm.
And so I realized, well, okay, I need to, and this was in October of whatever year, I think it was 2013, October of 2013. I said, I'm going to do it for the rest of the year and then take a step back and see if it's a good use of my time. And lo and behold, I got my first sponsor in December of that year. I also realized that even if no one's listening, which there really weren't people listening at the time, I would still get tremendous value from the relationships
Yeah.
that I created and that were formed. from these interviews. And by interviewing a new person each day, it's a lot of relationships, 365 new relationships a year.
Mm-hmm.
And so off I went, and I decided, yes, it is a good use of my time, and it's been so beneficial. And
Yeah.
now I do not do 365 interviews, even though the podcast does air 365 times a year. I have 3 team members who do the interviews primarily, and then I do about 3 to 4 interviews a month, and then they do the rest.
Yeah. No, that's I appreciate you sharing those insights. And I'd love to go back to the point you made of what, was it worth your time? And I think, even backing up from there, you started it, you kind of looked at it as like, it was still hard to even qualify whether it was worth your time. You got to sponsor things of that nature, but is it, was it still worth your time? And you made a good, valid point of like, you got to meet a new person, interview a new person every day. And so, just for the value of the relationship itself, it was worth it. And I think that's important because I think that, and back when I started mine, I kind of looked at it, and it's funny. I've got a funny story about starting my show. I had intended to start it about a year prior than what I did. And I converted one whole bedroom in our house to a studio. I thought you needed all this elaborate setup, a mixer board, which I never figured out how to use, sound deadening material, bought
Oh
this nice,
my.
I mean, like I went overboard because there was no good direction back then of even what type of equipment you should be using. I mean, I think there was a couple podcasts on starting a podcast, but these guys were like audiophiles. I mean, they had like this, that
Yes.
was their world. And that's all they knew is how
Yes.
to make things overly complicated. And so I did that, and I got discouraged, and I never started it. And my wife was like, if you don't start this thing soon, I'm putting this shit on eBay and I'm selling it. Right. Cause like, number one, you're taking up
Good
a
for
room in our
her.
house. Yeah. And you paid whatever, hundreds or thousands of dollars for this equipment that literally you never figured out how to use it. But anyway, long story short is when I finally started it, I went in with the idea that, like, number one, there wasn't a lot of great real estate podcasts, and I had been an early adopter of podcasts, but I found very quickly that I was running out of stuff to listen to. It just wasn't relevant. I wasn't really using my time
Mhm.
wisely by listening to what was out there, because there wasn't a lot on commercial real estate investing. There was a ton on fixing and flipping, wholesaling, maybe not a ton, but there was a lot. And I
Mhm.
think the Real Estate Guys radio show was the only one that was really around back then. And
The
that's fairly
original.
diverse in
Yeah.
nature. Yep. Yep. And so I went into it with the idea that, you know what, like if all that comes out of this is that I get to interview some really, really cool people, and some of those people might not even give me the time of day otherwise, unless they knew they were being interviewed for a show. And I can establish relationships out of that. And then in turn, however many people are going to be listening, I would be able to, if I have an interest in the same information, there's got to be at least one other person out there that also has an interest. And so if I can add value to them, that is good enough for me. And if something else evolves out of it, then great. And so but I look today that, I'm sure there's a lot of podcasts that start for that same purpose, right? They have, the higher purpose in mind of helping others. But a lot of folks, I think, saw more of a business behind it of, I'm just going to start a podcast because then I can raise money and I can sell programs, this, that, and the other. And I'm glad to hear that yours was really started for a very similar reason I started mine, just really looking to give back and meet some really cool people along the way. And ultimately it's become a big part of your business and your brand, and the same with us. So I appreciate you sharing all that with us. And what I love to know is just, I guess, going back in time is, talk to me about what that initial vision looked like. So once you identified that, there was value in doing this, you ultimately built a fairly large brand around the podcast, and with the best ever conference and just,
Mhm.
Ashcroft. It's all been kind of morphed together. When did that real, that larger vision really come to mind? I mean, like, was it within the first year you kind of knew where you wanted to go with this, or has it evolved over time? Or just give us some additional context if you would.
It certainly evolved over time. There wasn't a moment in time where I thought, wow, this could be when I was starting, there wasn't a moment in time, I should say, where I thought, wow, this could be a really good platform for me to elevate my personal exposure and other things that I'm doing is exposure. It was more about um, it really was more about one relationship at a time, and just focusing on the growth of the podcast, knowing that a quote that Zig Ziglar said would likely come to fruition, which is help enough people get what they want and you'll eventually get everything you want. Another is service to many leads to greatness.
Mm-hmm.
And then on my vision board, that is on my wall that I've had this quote on my vision board for the last 4 or 5 years is the secret to living is giving. So I know, and I've always known since I've been focused on personal development that help enough people get what they want, and you'll eventually get everything you want. Add enough value to enough people, and you're going to get everything that you want. So I just knew that this was the right approach, but I didn't make the business connections out of the gate that, hey, this could really help me make money in the following ways. It was more just I trust I gave trust to those who have been before me and the approach because it felt good. It was building relationships that felt good. I was learning. I mean, imagine, I probably did the first 1,500 episodes. I interviewed people personally. I don't know exactly what number I started bringing on team members, but I'd say about first 1,500. So imagine having one-on-one conversation with 1,500 different experts or budding experts in a particular field. Like you want to study anything, if you talk to 1,500 different people for 30 minutes about that topic, you're going to get better at it. And so I realized, I'm a huge, as I mentioned, personal development student. And one person I also like to read from is Tim Ferriss. And Tim Ferriss talks about 50-50 goals. And I love that. And the 50-50 goal is 50% of the goal that you set is accomplishing that goal. But the other 50% is, regardless of if you accomplish the goal or not, will you still benefit having gone through the process? Mm-hmm. Are you setting yourself up to benefit having gone through this goal-seeking process? And if so, if you can say, you know what, regardless of if I hit the goal or not, I'm still going to be much better off for having gone through it, well, then that's a worthwhile goal to attempt to achieve. And with this podcast, like we were talking earlier, and if no one listens, I'll be like, what the heck am I, what's wrong here? And what am I asking that I'm not, what am I asking that I shouldn't be asking, and vice versa? But hey, I'm going to build relationships with people, and that's going to be worthwhile regardless of if the other goals are accomplished.
Yeah, no, I love that. I love that. And, given all those conversations that you've had over the years, was there ever a point in time? So you've been a multifamily guy, since when you started that show. I know you started off with a few other types of, residential investments, like a lot of us do, but ultimately you found very early on that you wanted to, be a multifamily expert. You wanted to focus in that niche. Obviously having, thousands of interviews, right, and talking, one-on-one with other real estate investors from a variety of niches. Was there ever a point in time where maybe you questioned earlier on, where you questioned whether multifamily was the right sector for you to be in, and you had to kind of tamper down the shiny object over here?
The short answer is no, and the reason why is because I would prefer to go to a restaurant that exclusively focuses on Italian food if Italian food is what I'm in the mood for, versus going to a diner that has Italian food but also has sushi and also has tacos and also has hamburgers and donuts. I love donuts.
That's a really strange diner that you're describing there. But.
Except for the sushi, there are tons of diners like that. The sushi is a curveball probably in that scenario. But there's a lot of restaurants that have multiple types of dishes, and there are other restaurants that focus. Hey, we're the Italian restaurant. We make our own pasta from scratch, and you can see the process through these glass windows and you can see us, the people working. And I want to go, when I want Italian, I want to go to an Italian restaurant. And so I believe in the power of focus.
Yep.
I believe in the ability to make money in any property type in commercial real estate. Mm-hmm. I know you can make money in any property type in commercial real estate because people do make money in any property type in commercial real estate. So it's possible. And people are doing it. But I believe in the power of focus. So I believe that, hey, we've got one property type, multifamily, and it does well, and I can communicate why it does well. And it's common sense to most people for why multifamily does well. And it's something that most people are familiar with and comfortable with relative to other types of properties in commercial real estate. So I've never ventured out of it.
Yep.
On the general partnership side. On a limited partnership side, I have, because I'm not the one doing the work, someone else is. So I have invested in mixed use, I've invested in industrial, I've invested in retail, done ground up development. And when I say done, I put money with someone who's done that. I haven't done it. Ground up development, just like 1% of my LP investments are with that. But the other items I probably have. So I have right now about 150 passive investments as an LP. So 150 separate LP investments, and about 130 are multifamily, and about 20 are mixed among other stuff.
That's a lot to keep track of, buddy.
Well, I actually just met with my wealth management team today, and I was previously keeping track of it in a spreadsheet, and they're like, "Wow, how are you doing that?" I was like, "It didn't seem overwhelming to me. It's pretty simple. I've got, how I made the investment, if it was through an LLC or if it was me personally or my wife, who the operator was, what market, what type of property type in commercial real estate is it, or whatever the strategy is, grounded development, office, whatever, how much I invested, what the preferred return is, what is that monthly, and that's it. But now I've got a team, so they look at it in more depth, like what markets are, and what market I put, what city is it in. And so now I brought on the team so that we could do an ongoing assessment of what operators perform the best, what markets perform the best, what property types perform the best, and see if I can find any trends there, and which ones underperform, which ones overperform. Because at this point, I've got a large enough sample set to figure that out.
Yeah, no, I love that. No, it's interesting. I mean, I've got a spreadsheet, but so what you were doing, just I'm curious here because I've got like 30 LP investments, which is, I mean, that's a lot in of itself. And so obviously, whatever the pref was laid out as, I mean, you can do some rough calculations based on your initial investment as to what that should be. But obviously a lot of deals aren't necessarily paying the pref right out of the gate. And so were you literally going in once a month or once a quarter into the portal and actually real time updating that spreadsheet?
No. Okay. No, it was that pref, whatever the pref was, I just put it, and then that would be the projected monthly cash flow, but it probably wouldn't be for year 1 or 2, maybe starting year 3.
Yep.
Because I didn't have the desire to do that
a lot of bandwidth too.
But now I have that wealth management company, and they do log into the portals on my behalf. Yep. And then they see if I'm getting distributions as we expected, or higher or lower, and they have the projections for each of the 5 years. Typically, they're 5-year projects for each of the 5 years, and then they red flag anything that's below what's being projected.
Yeah, no, fantastic. I love that. So I would love to. You've done over 2 billion, or you have over 2 billion of assets under management. Would love to, if you wouldn't mind, peeling back the curtain a little bit and give us an idea of what your team looks like to actually be able to, have, over 2 billion of AUM. I mean, who's on the ship?
Yeah, well, department-wise, first off, it's myself and the co-founder of our company, Frank, and we have complementary skill sets. I was just reading the book Shut Up and Listen by the guy from Houston who owns all those restaurants and owns the Houston Rockets. I forget his last name, but anyway, he's a really successful, financially speaking, at least, entrepreneur. And he mentioned in the book, don't bring on partners who have the same skill set as you. And I was like, yeah, definitely don't want to do that. And I've seen people do that, and it's been a mistake. So fortunately, my business partner we have the complementary skill sets. He oversees the asset management and acquisitions, and I oversee the funding portion. So I make sure we've got the money, and I help with some of the business plan and other things, but that's my primary responsibility. His primary responsibilities are to find the deals and then to oversee them. And again, we overlap slightly, but not a whole lot. And so the departments, well, we've got a chief operating officer, or excuse me, chief investment officer. He heads up the acquisitions team. And then we have a director of asset management. She heads up the asset management team, and Frank oversees them. And then on my side, we have 3 departments. One is marketing, 2 is investor relations, and 3 is investor services. So marketing finds the investors, investor relations speaks to the investors, investor services helps investors with administrative things to sign up for the investments, and also answers questions that are more tactical in nature and not deal specific after the deal closes. And I just promoted someone from she was heading up investor services. She is now overseeing those 3 departments, whereas I was overseeing them before. So now I'm just working with her directly, and she got promoted. She's been with us ever since the beginning, all 7 or so years since we started. Awesome. And she's overseeing marketing, marketing, investor services, investor relations, and it's been an evolution. Certainly, 4 years ago, it was maybe 4 to 5 years ago, it was just me. It was speaking to investors and then helping them through the process along with the team member who she just got promoted. So certainly we've built out the team, and under me, we have about 20 people across those 3 departments, full-time employees.
Is that all in-house? You've got all that in-house?
Yes.
Well,
all
not necessarily under the but like underneath your umbrella.
Yeah, all full-time employees. And then under Frank, I think there's probably another 20, 25. So all in, we're probably around 50 or so employees, not including our property management company, which
that's
is
in-house. You've also
we have an in-house
now.
Yeah, we have an in-house property management company. And for any general partners who are thinking about that, just get your wallet out, baby, because it is expensive to launch a property management company, and it is not a profitable venture if you're looking at it from what the property management company makes. However, it certainly will be profitable if you're looking at it for how well you can manage relative to third parties to outperform the business plan. And that's where we make our money, from the in-house property management. But if you count that, Birchstone, if you count Birchstone as the employee count, we have $2.6 billion worth of apartment communities, so we're at 400 plus employees.
Yep. No, and you guys built that from scratch, or did you acquire?
From scratch. Did not acquire. No. And Frank, I'm not going to take credit for this. Frank led the charge on that exclusively. I wasn't involved for building that out, but he, first was hire the president, David Dietz, and then after that, build it from there. And they built it out, and there's a good number of employees under that, and we're headquartered in Coppell. So for those familiar with DFW, you know where Coppell is.
So the catalyst was obviously, we think we can do it better. I mean, that's I probably simply stated, but the action of actually, building and then truly performing is, better than that of what the predecessors, the other, outsourced management groups had done. I mean, was there any point in time where you guys just felt like that might not have been the right decision as you started going down that path, or did it always feel right from the get-go?
As we were laying out millions of dollars,
yep.
That's challenging. But ultimately, what we found is that I would say there's two main benefits to having our own property management company. One is we optimize operations because there's less red tape and we can control things better and we make it how we want it. But then two is actually something that doesn't get talked about a lot, and that is cost of supplies. Because we're able to we have our own warehouse, and it's located in DFW, and we get most, not all, most of our materials shipped directly from overseas. Mm-hmm. And we are coordinating that process. Our team is, and we're getting items at 30%, 35% discounts relative to what we were getting it at. And so our cost of goods is lower as a result of it. And not only that, but it's higher quality items that we're getting for less money. And when you're doing renovations on 10,000 apartment units, that's a big deal. That adds up. And so it was eye-opening to me, the type of cost savings we get and how we're able to have better quality materials than what we were having before, which ultimately keeps residents in their home longer and increases the bottom line because it's higher quality materials.
Yeah, very interesting. And are you guys offering third-party management services outside of your portfolio?
Nope. Because there's relatively no money in property management. So we don't care. We have no desire to expand to manage other people's properties. Yeah, it's the money is made with our properties and optimizing it and doing it better, doing our business plan better. We'd like break even and expand just to expand, only to eventually some operator creates their own management company and then fires us and we have to lay off all these people. It would make zero sense to do that.
Yeah. No, I always refer to our property management division as the necessary evil. It just is.
Yeah. Yeah.
But
I wouldn't say that to them.
Okay. Well, yeah, you get what I'm saying. Not to be derogatory.
I'm going to retract my because I don't want this.
Fair enough.
I
appreciate you catching that, and I love everyone on our team, and we wouldn't be where we're at if it wasn't for them. So like I did not mean that in a derogatory manner, although now it sounds like that, Joe, because you called me out on it. So, but anyway, it's not an overly profitable business. We'll leave it at that.
but it makes you a lot of money.
Yes,
through the business.
Not directly profitable.
Yeah,
yes, right on
exactly.
the investment side. Absolutely. So, some of the other evolutions in your business over the years, for the most part, you guys used to do just deal specific syndications, capital raises for one individual deal. Over the last, what's it been, 2 years or so, give or take, that you guys started doing the fund structure?
Yeah, about 2 years.
Talk to me about again the catalyst there. What really pushed from doing one individual deals to going more of a fund model, and then maybe some of the pros and cons associated with each.
Yeah, well, I think the pros and cons will address the first question. So let's talk about that. Well, we realize that so as I mentioned, I'm on about 150 deals as an LP. So I know the world through the LP's perspective. And as an LP, my preference is to invest in funds versus individual deals. And the reason why, going back to the pros and cons question, the reason why is because, well, my money is tied to multiple assets. If I believe in the asset class and the business model, then I'm going to want to invest in multiple deals. Mm-hmm. And why not have my money connected to multiple deals to diversify the risk, assuming that I believe in the business model and the operators? Because if one deal goes wrong, well, my money is gone. If it's an individual, one deal goes wrong and multiple deals, well, the other deals that I believe in, and I believe in the business model, they'll likely cover that one deal. Mm-hmm. And so I believe it's better for the LP to have a fund structure. And on the flip side, though, what's a con for the fund structure? Well, if one deal and I invest in one deal does extremely well, and great, I just hit a grand slam. But if it's in a fund and one deal does extremely well, well, you got these 3 or 4 other deals that are probably going to bring it down to earth, and you're not going to hit the grand slam. And so there's most likely less less tremendous upside, but there's most likely less drastic downside. So you're probably going to meet somewhere in the middle on the fund structure. And so I'd prefer that, because my number one goal is not to lose money as an LP. And then number 2 goal is to grow the money. And so that's from an LP's perspective. But I'm not a purely altruistic person. And so how does it benefit the general partners also? So great. It's, in my opinion, it's better for the limited partners, but now how do the general partners benefit? Well, it's beneficial because as someone who was doing single deals, when you have one deal, and let's say the money raises $20 million, and you know what I'm talking about, and every general partner will know what I'm talking about when I say this. Okay, if it's the raises $20 million, it's 2 weeks before closing, you're at $18,500,000 that are funded, and you're chasing down the last $1.5 million. And you have some investors who have said, yeah, I'm in. You can't get in touch with them. You have some investors who said, yeah, I'd like to be in, but you can't bring them in yet because you haven't figured out what's going on with the first investors. And someone funds for less than what they said they do. Someone funds for more than what they said they do. And it's like trying to landing on that $20 million mark exactly is like, I say, trying to land a helicopter on top of a mountain on a windy day. It's like it's just really challenging. And with a fund model, we don't have to go through that, except for at the very end of the fund where we have a target amount. But if we buy 5 deals, we just rock and roll, raise money throughout the year until we get to the end of the 5th deal. Then we've got to make sure that we're landing on that right equity amount. But for as long as our money isn't outpacing the deals throughout the year, which it hasn't in our scenario, we've raised about what we need for each deal at the time that we needed the money, then we just raise the money throughout the year. And it's very beneficial from a general partnership standpoint. We don't have to do that coordination in those logistics. Another benefit from a general partnership standpoint is, well, we can raise money throughout the year. And even if we just closed on one deal and we haven't identified the second deal that we're buying that year, doesn't matter. We can still raise money for the fund. And so we can bring that investor into the fund today versus telling him or her, well, we've got to wait until we find the next deal. I'll keep you posted. So there's the delay from an investor standpoint is no longer present because they can immediately invest.
Yeah. No, that's great. That's great. I think you hit on all the valid points there. And so when you guys switched to that model, did you find that there was any trepidation from maybe some of your prior investors that were just so used to the deal specific syndication model? Because I mean, that's much more prevalent, especially in the retail investor world, than that of a fund structure. And so any hurdles there of just more so re-educating folks as to, the benefits associated with the fund versus a deal specific?
Yes, there were challenges. I would say about 25% of our investor group was asking good questions. We're asking good questions. And I'd say probably 5% chose not to do the fund structure because they just weren't comfortable with it. And so yeah, that was a challenge, but it was something that was a very small percentage of our overall investor group. Most of them realized the benefits that I mentioned. I mean, you get the same type of K1 structure with passing through to depreciation and cost segregation, and with the fund that you would individual deals. So, and same with 1031 options that we offer our investors when we have them. So those were all similar or the same. And so we all, what I was concerned about was, would an investor who invests 75,000 per deal with us previously, would they only do 75K in the fund, and then they're done for the year? So, now they're not doing
Oh, right.
225K three times, or 75K three times. They're just doing 75K once. That's what I was concerned about.
Mm-hmm.
And what I found is that our average investment doubled, actually a little more than doubled, with the fund structure than compared to individual deals. So investors were investing more in the fund than they would in individual deals.
That's fantastic. Yeah, no, that's great. And I think one point to really hit home here is that, and not saying that one can't have success with a fund model prior to doing maybe a number of deal specifics and building a track record, but I do think that a track record plays a lot into
For
even speaking to
sure.
you and I, right, like before we rolled out a fund, we had done a number of deals that we could look back on and say, like, here's performance over the last 3 years with individual deals we've done. We intend to buy this same exact deal profile, but within this fund structure, and here's what that might look like for you, right? And so it's much easier selling point to saying, like, guys, we got this idea. We're going to go buy X number of properties over the next 12 months. We're raising a $50 million fund, and you believe in that idea? Well, come along for the ride.
Yeah, great point. Great point. And
And
you're
you guys
exactly
always
right.
do some seed deals though too, correct? Like, you always, before you
We
launch a new
only,
fund, I mean,
y-
you have a deal or two identified before you launch
oh,
that new fund.
yes, C
Yep.
deal. I thought you were saying 506C as in
Oh,
cat. I'll
right,
say we only do 506C,
right.
but now, but yes, seed deals. Yes, we like to launch the fund with a deal,
Mm-hmm.
and we did this year, and we did the first year, and I believe we did so we're on our third fund. We just launched our third fund 2 weeks ago. And I believe for the second fund, we also launched with the deal.
Yeah. Yeah. Well, fantastic. Well, I know we're running out of time here, Joe, but I would love to, maybe flip this real quick to just the personal side. And when, I know you've got a young daughter, 4 years old, you're married, you've got, this, tender balance of work and personal life with your family. And so talk to me, how do you maintain?
Um, Integration versus balance, something I learned from Tony Robbins.
Mm-hmm.
I tried to integrate, and I think I do a decent job of it, integrating the family into activities that I do for business as much as possible and where relevant. Then also, I think it's important to have personal time, or excuse me, business time alone to obviously focus on things.
Give me an example
Um,
of what
yeah,
that
I'll give you an
integration
example.
looks like.
So for example, going on a property tour, or going to the market with me when I go on a property tour. Sometimes most of the time, my wife and my 4-year-old daughter do not go on the property tour with me, but they go to the market with me.
Yep.
If that's a trip that we all want to do, and that will be a personal trip, and they pay their own way, and we stay a little longer. um, I'm very intentional about um, my focus and how I invest my time. As I mentioned, I have a vision board. It's printed on my wall. It's on my phone, and it's on my lap. It's on my desktop. It's the backdrop for all those, my desktop and my phone.
Mm-hmm.
And it has LPPQ on there. It stands for Love, Protect, Prepare, Quinn. I think those are my three responsibilities for Quinn, my daughter: love her, prepare her, and protect her. I have JC with the magic wand. That stands for Joe, Colleen, my wife, and the magic wand stands for magical moments. I have, my priorities, the top three: health, freedom, and enjoyment. If I don't have my health, then I don't have anything else.
Mm-hmm.
Freedom is very important to me, and then enjoyment, and they're integrated in all three of those aspects. I have someone who I have a weekly call with. He's someone who I met and become really good friends with through a mastermind. And we do a call every Tuesday at 10:30 a.m.
Mm-hmm.
And we talk about our progress towards our goals. And he's on a similar, if not greater level, financially and professionally than I am. and we're not in the same industry. And so it's great to be able to have a conversation with him about things candidly and talk to him about things on the family front and otherwise. And I'm constantly seeking other ways um, to to uh, to enjoy my time with my family. I have goals. During that weekly call, I go over my goals that I have for the month. One is my wake up weight. So how much do I weigh that morning? I'm tracking that in a line graph over time.
Yep.
But then two is volunteer hours for the month. My goal is to volunteer 10 hours a month. Another is 4 lunches with Quinn and Colleen a month. Another would be 2 dinners, just alone with Colleen a month. Another is 2 trips, fun with a purpose trips for the year with Colleen and Quinn. And so I'm very intentional, and I track things about what I do with my family.
No, I love it. I love it. And I appreciate you sharing that. That's awesome. And it's funny, just a little humor note here is that I just found out a couple of weeks ago that you're not supposed to weigh yourself before you go to bed. It's supposed to be that morning weight. I didn't realize there was such a major difference between.
There's a big one. Yeah.
And I've always been into health and fitness, and I literally never even owned a scale until like 3 months ago. And I went on like this intentional path to really try to become the best of myself with muscle gains and things of that nature. And I literally was keeping track, day by day. And my wife caught me one night weighing myself around the bench, and I was really pissed because I'm like, what the hell? It was like 6 pounds difference. I mean, it was huge. And and that's when I learned the magic of it. It has to be in the morning.
Yep.
Preferably after you go to the bathroom.
Right. Yeah. Before I drink a liter of water with a scoop of wheatgrass in it every morning, and so I weigh myself before I drink that.
That's funny. That's funny.
And I take my contacts out. No, I'm kidding. I don't have contacts, but I heard a comedian talk about that. I take my contacts out. I clean my earwax out before I weigh myself.
Well, buddy, it's been a pleasure catching back up with you again. Been way too long, been a couple years, and really glad to hear that everything's going so awesome with your family and professionally as well. And just keep doing what you're doing, man. You're doing big things and making big impacts on people. So thank you for all you do.
Grateful for this conversation.
And Joe, real quick, for those that want to learn more about maybe what you got going on, investment opportunities, what is the best place, or where is the best place for them to to engage or to get more information?
Well, you could hear directly from our investors, actually. You can go to our website, ashcroftcapital.com, and then there's a button there that says Investor Perspectives. And there's over 100 perspectives from our investors who have invested with us. And, most of them are videos. There's also written testimonials, people from different types of backgrounds, doctors, military, managers I'm seeing, logistics, manufacturing, real estate developers, etc., writers, and just listen to what they say about investing with us.
Yeah, that's awesome. That's awesome. Well, Joe, appreciate your time, my friend. And again, keep up with what you're doing, and looking forward to keeping in touch with you, and hopefully get another update here. Not 3 years, maybe sooner than that next time around.
Good talking to you, Kevin. Thanks, everyone.
All right, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.